Welcome to this explainer. Today, we're going to learn exactly how to defeat the absolute beast that is market volatility using a structured, noise-canceling trading strategy. If you've ever felt completely lost just staring at a screen full of chaotic, moving prices, well, you are in the exact right place. We're going to take those complex market movements and break them down into a crystal-clear, repeatable system. Look, if you're a beginner or even an intermediate trader and you're feeling totally overwhelmed by chaotic charts and noisy, tangled indicators, you are definitely not alone. It's incredibly common to stare at a screen, second-guess your entries, miss the actual move, and then just watch a trade you skipped hit its target perfectly. It feels like the market is actively working against you, doesn't it? So here is the real secret. The problem isn't the market itself, it's the noise. And today, we're building a repeatable system to filter all that out. You see, the market doesn't move in straight lines. It zigzags, it spikes, and it drops based on news and emotion. To survive, let alone thrive, we need a lens that blocks out that arbitrary price action and focuses only on true momentum. Let's start by defining our core weapon for this, which is the Exponential Moving Average, or EMA for short. Think of it as a dynamic trend line for your charts. Unlike a standard line drawn from point A to point B, the EMA constantly adjusts. By giving more mathematical weight to the most recent price data, it hugs the current price action really closely, making it act way faster than traditional averages. Now, you might be wondering, why not just use a traditional, simple moving average? Well, the answer is speed. The EMA completely outperforms the SMA by cutting down the lag, so you can react to actual momentum. You see, a simple moving average treats an old price from 50 days ago with the exact same importance as today's price. The EMA fixes this flaw. It prioritizes what the market is doing right now, which means you get into trends earlier and you spot reversals much faster. By simply reading the slope of the 50-period EMA, we immediately eliminate a huge chunk of false signals. It tells us right away whether the market is actively trending or just chopping sideways. If the line is pointing up, the trend is gaining strength, and we only look for buy setups. If it's pointing down, we only look to sell. And if that line is flat, that means the market is ranging, and we simply sit on our hands. Honestly, this one rule alone will save you from countless unnecessary losses. A single EMA is a fantastic start, but to truly filter the market, we need to layer our strategy with the 20, 50, and 200 EMA. I call this the power trio. Relying on just one indicator can sometimes leave you vulnerable to sudden localized whipsaws. But when we stack these three specific moving averages together, we create a really robust multi-time frame filter right there on a single chart. When we stack these together, we create what's known as the perfect order setup. Here, your 20 acts as your ultimate trend filter, the 50 helps time your entry, and the 20 tracks the immediate speed of the price. When they're perfectly stacked, meaning the 20 is above the 50 and the 50 is above the 200, you've got a verified high-probability bullish trend. If that stack reverses, you have a verified bearish trend. This alignment ensures you are literally never trading against the broader market current. Looking at this historical data, we can visually anchor this concept. Notice how the price repeatedly dips down to touch those moving averages, only to bounce right back in the direction of the trend. The EMAs act like a safety net, catching the price and propelling it forward, while completely filtering out all that chaotic daily noise. Okay, if you take literally only one thing away from this explainer, let it be this golden rule. Trade the pullback, not the breakout. Waiting for the price to return to the EMA gives you a far safer entry. Amateurs love to chase big, exciting breakout candles, but that's exactly where the smart money is selling to them. Professionals, we wait for the price to calmly retreat back to the 50 EMA. It feels slower, sure, but it provides incredible structure and safety. So the crucial point is recognizing what a healthy pullback actually looks like in the wild. It looks like a quick dip to the EMA, followed by an immediate rejection wick and a firm closing price. You want to see the price tap that 50 EMA zone and instantly bounce, kind of like a hand touching a hot stove. Those small wicks left behind on the candle, they're telling you that buyers are actively stepping in and defending that moving average. But as you might guess, not all pullbacks are friendly. We have to spot the warning signs of a weak pullback to avoid getting trapped. This is where the price rudely slices straight through your EMA zone with heavy, sideways momentum. If the price reaches the 50 EMA and just stalls out, painting 5 to 7 candles going absolutely nowhere, the momentum is dead. Or worse, if a giant deep candle disrespectfully cuts right through the line and closes on the other side, the setup is totally invalidated. You just walk away. Now, to make absolutely sure we aren't getting fooled by false signals during those pullbacks, we're going to top off our layered cake with an oscillator, like the RSI or stochastic. Because moving averages inherently lag just a tiny bit, pairing them with an oscillator gives us a real-time read on whether the market is truly exhausted and ready to turn, or if it still has room to run against us. This brilliantly illustrates how combining our EMA trio with a stochastic oscillator reveals clear market exhaustion, showing us exactly when momentum safely aligns with our trend lines. When the price pulls back to our 50 EMA, you just glance down at your oscillator. If the stochastic is crossing out of the oversold territory exactly as our price bounces off the EMA, boom, we have a beautiful high-probability confluence signal. Two completely different mathematical formulas are telling us the exact same story.
All right, let's dive into the final piece of the puzzle. Because let's be real, a perfect entry means absolutely nothing if you don't have a structured, emotionless way to take your profits and manage risk. This is honestly where most traders fail. They do all the hard work to find a great trade, but then panic when it comes time to exit, either cutting their winners drastically short or letting a tiny loss spiral out of control.
By strictly following these core exit rules, you take all that subjective, panic-driven decision-making entirely out of the equation. Always aim for at least a 1 to 2 risk-reward ratio. If you're risking $50 on a setup, your target must automatically be set to make 100. As the trade moves in your favor, trail your stop loss right behind the EMA. And if a candle ever decisively closes against your 50 EMA, you exit instantly. No hoping, no praying, just pure execution. Now, what's really interesting here is that knowing when not to trade is your true superpower. If the lines are flat or tangled up like a braided rope, you simply protect your capital and stay out. Remember, the EMA strategy is a trend-following system. It literally demands a trend to function. If you see those 20, 50, and 200 lines twisting around each other, the market is lost. Just protect your capital and wait for the lines to fan out into their perfect order again. Take a quick mental screenshot of this checklist right here, because strictly applying this criteria for your trend, entry, and risk is exactly how you cut through the market noise over the long run. Step 1, verify the stack. Step 2, wait for the pullback and that rejection candle. Step 3, define your risk and your 1 to 2 reward target. If all 3 of those boxes aren't checked, the trade does not happen, period. Ultimately, the market doesn't care how many chaotic indicators you've crowned onto your screen. It only rewards absolute consistency. Successful trading isn't about outsmarting the market. It's about waiting for the market to reveal its structure and then executing your repeatable system without hesitation. So the next time the market tries to trick you with a massive breakout candle, will you be the amateur chasing the noise or the professional waiting for the perfect pullback?